Bill Hornbarger, Chief Investment Officer at Benjamin F. Edwards, with some comments on what's happened in the equity markets. Well, as most of you are probably aware, many of the domestic equity indices are either in a bear market, defined as a 20% peak to trough decline, or flirting with the bear market. And by now, most of us are familiar with the litany of reasons for this weakness in the equity markets. Heightened inflation above 8% on a year-over-year basis in the latest report, evolving Fed policy, higher interest rates, shrinking of the Fed's balance sheet. We've got stretched valuations is something that the market's been talking about. And then finally, earnings and recession fears. Bear markets and corrections are inevitable. They're going to happen, and to realize the returns that stocks have historically provided, investors are going to find themselves exposed to bear markets and corrections periodically. And while it's difficult, if not impossible, to know how and when a bear market is going to start or when it's going to end, they do end. And how an investor acts, what actions they take, their thought process during a bear market can have a very large determinant on their own financial journey and their own financial success. So with that in mind, just a couple of thoughts that have come to mind as we work our way through this tough time. First of all, tough markets are inevitable. By our count, we've had 21 bear markets since 1928. Or one about every 5 years. And if you think about more recent history, most of our personal investing history, we had the 2008-2009 global financial crisis, 50% plus decline in the S&P 500. We had the 2020 COVID bear market, more than 30% over several weeks. But even away from that, we've had the current decline down over 18% peak to trough. And even the fourth quarter 2018, a lot of people forget about that. The S&P 500 was down 19.8% in that fourth quarter before rebounding. So the point of it is that these things happen. They are inevitable. We're going to find ourselves exposed to them. A successful investor, we feel, must be resistant to panic and euphoria. Have a plan, have a strategy, be disciplined, and stick to it. Don't try to become a market timer in a tough market environment. And on the flip side, don't chase the hot stock, the hot sector in a bull market. Again, we think it's very important to be unemotional, particularly in these tougher market environments. I think a good investor realizes that the current declines actually create opportunities, and it actually increases the prospects of forward returns. Put another way, price matters, and things are cheaper today than they were at the beginning of the year. That should be an opportunity maybe to selectively deploy capital into the marketplace and realize that these tend to be attractive entry points for longer term investors. Discipline rebalancing and a stringent asset allocation program and discipline to sticking to that actually are effective risk management tools. And they actually help with the urge to do something in a bear market, right? There's nothing that says you have to discipline on a time basis. You can certainly take advantage of these declines in equity prices and rebounds into stocks. And again, it sends good behavior about buying things when they're a little bit cheaper. Market timing is hard. I think this one's really important. A lot of people feel that they're long-term investors, but they want to become market timers in a stressed market environment. And we would point out that effective market timing takes a lot of correct decisions: when to get in, when to get out. You have to realize that taxes can eat up the benefits of some of those moves. And then finally, in our experience in tough market environments, good days and bad days, big up days, big down days tend to be clustered close together. We had an example of that last week with the NASDAQ up 3%, down 4% on successive days. And so we want to make sure that we don't miss those big up days and instead, again, stay exposed to the equity market as we work through this. And finally, the thing that we would say is that equities have been, and we think will continue to be, one of the best ways to create wealth over the intermediate and longer term, and we shouldn't lose sight of that even in these tough market environments. As always, if you have questions, if you have comments, if you want to have a discussion about any of these things, your Benjamin F. Edwards advisor is close at hand and willing and able and wanting to engage in those conversations.